Welcome back to the Deep Dive. Today, our mission is extremely focused. We are going to plunge right into the Indianapolis warehouse market.
And specifically, we're looking at sources that are framing this current, let's call it atmosphere, as maybe the best buying opportunity for investors in years.
It's an essential deep dive because on the surface, the national numbers, they look, well, confusing or even worrying if you're an investor.
Oh, absolutely. You're seeing headlines about, double-digit national vacancy, rent growth is slowing down. In some cases, it's even negative.
And that's the classic dilemma, isn't it? It's the feeling you get when the headlines are all screaming crash, but the underlying data, especially when you zoom in locally, is kind of whispering buy.
Right. So the core idea we have to unpack is this national rebalance.
A rebalance. So the market correcting a boom that was, by all accounts, just fundamentally unsustainable.
Exactly. And we're here to show you why central Indiana, and we mean the whole metro area, from Plainfield and Whitestown all the way up through Boone, Hamilton, and Hendricks counties, is such a critical and frankly unique outlier to that national trend.
Okay, let's dig in with some healthy skepticism then. I'm looking at the Q3 2025 national metrics, and they are stark. When I see 11.2% national vacancy, that feels like a massive problem, not an opportunity.
It does, and that's where we have to shift our perspective away from, immediate fear into our historical context. The whole narrative of a market crash is it's flawed.
How so?
Because what we're really seeing is a return to a healthy long-term average. Let's start right there. That 11.2% vacancy number.
Highest it's been since 2011. That sounds like trouble.
It is the highest in a while, but you have to remember this crucial insight. The long-term, sustainable, healthy average vacancy for industrial real estate is somewhere between 7 and 9%. The 3 to 4% vacancy we saw from 2021 to 2023, that was the anomaly. Our sources describe it as a rubber band stretched too far. It had to snap back.
And the snapback is what creates the opening for buyers.
It's what creates the pricing leverage. Exactly.
So the market isn't broken, the frenzy was, and now we're just getting back to normal. But that doesn't feel like it would happen instantly.
It's already well underway, and you can see it most clearly when you look at new supply.
The construction pipeline?
Yeah, the velocity of the drop nationwide is fascinating. At the peak of the boom, we were delivering 480 million square feet of new supply a year.
An incredible number.
And by Q3 2025, that annualized number had collapsed by 85%.
85. Wait, that's not a slowdown. That's slamming on the brakes.
It's a full stop. And for an investor, this is the key forward-looking indicator. It means almost no new competition is coming online for the next 18 to 36 months in most places.
So the imbalance is fixing itself because the pipeline has just run dry.
And we know what happens next. Historically, a mere 1% drop in vacancy tends to trigger 8 to 12% rent growth the following year. We're setting that stage right now.
Okay, but let me challenge that for a second. Even if the pipeline is dry, higher vacancy still means more pressure on landlords today. National asking rent growth hit negative 4.1% year over year. You can't just ignore that.
You can't, but you have to connect it to the volatility. Rents aren't crashing, they're just normalizing after the most insane spike in history.
I mean, some markets were up over 30% year over year.
Right, utterly unsustainable. A correction was always coming. But the key distinction is this. In a really strong submarket like Indianapolis, modern high-quality space is still getting positive rent growth.
Because the actual users, the demand, never went away.
The demand never disappeared. What vanished was the speculative building.
Which brings us back to the construction pipeline. What's actually left under construction right now?
Just 118 million square feet nationwide. That's the lowest it's been since 2014.
And there's a historical trigger point there.
Yeah, there is. The moment that pipeline number dips below 150 million square feet, well, history shows that vacancy starts dropping within 12 to 18 months, and that's when rents start to accelerate again. We are already past that inflection point.
Okay, so the national story is a healthy correction, creating a maybe limited time buying window. I get that. But if the supply constraint is everywhere, why should an investor focus on Indianapolis over, say, Dallas or Atlanta? What makes it so special?
It comes down to two massive, long-term structural anchors that guarantee future demand, basically regardless of what the Fed does next.
Let's start with the one everyone in the Midwest is watching, the economic titan.
Eli Lilly. Their expansion, it's a multi-billion-dollar manufacturing investment. It's the single largest pharmaceutical investment in U.S. history.
And we're not just talking about a new office park here.
Not at all. This is heavy manufacturing, complex logistics, supply chain. Infrastructure that takes decades to build and sustain, and the ripple effect is just exponential.
Right, because it's not just about the space Lilly needs for its own stuff. It's the whole ecosystem they create.
Exactly. For every one of those direct, high-paying jobs Lilly creates, industry estimates project 4 to 6 indirect jobs in logistics, manufacturing, and support services.
That's a huge multiplier.
It is. And that ripple effect alone is projected to require somewhere between 15 and 20 million square feet of new industrial space over the next decade.
And most of that has to be close by.
It has to land within a 45-minute drive of downtown. It's a guaranteed floor for the market that almost no other city in the country has right now.
That is an enormous demand signal. So what's the second anchor? You said it was maybe the most surprising one.
It's power capacity, and infrastructure.
Power.
This is the single biggest advantage Indianapolis has right now, and it's all about speed. Duke Energy is in the middle of a massive $2 billion plus grid upgrade program.
$2 billion.
Yeah.
What does that actually get you in terms of a competitive advantage?
It gets you some of the shortest power delivery timelines in the entire country. If you're a big industrial user, someone who needs 10 or more megawatts.
Which is a lot of modern facilities these days.
A ton of them. Well, in key counties like Hendricks and Boone, you can get that power delivered in 12 to 24 months.
Okay, so I have to pause on that. 12 to 24 months, how does that compare to the national average?
That's the whole story. If you're trying to build a new automated facility in most other major markets, Arizona, Georgia, you are facing waits of 36 to 60 months.
3 to 5 years.
3 to 5 years. Power availability is the #1 gating factor in site selection right now, and Central Indiana has solved for it faster than almost anyone else.
That completely changes the game. You're not just competing on location anymore, you're competing on infrastructure access. So let's zoom in on the submarkets. Where is this showing up in the Q3 data?
Okay, let's look at 3 key corridors. First, the Northwest Corridor. That's Whitestown, Lebanon, Boone County. It is currently the tightest large-scale industrial submarket in the entire Midwest.
What's the vacancy rate there?
An astonishingly low 4.8%.
So it's basically defying that 11.2% national average completely.
Completely. And you see it in the land values. Land has gone from maybe $8 a square foot in 2021 to between $28 and $35 today.
Wow. Why?
Because every single speculative building delivered there since 2023 was 100% pre-leased, often before the roof was even on.
Okay, now what about the traditional heavyweight, the Southwest Corridor? Plainfield, Avon.
That strength links directly back to that power advantage we just talked about. Duke's newest substation there can deliver over 20 megawatts immediately.
Plug and play.
It's plug and play, and that translates directly into premium rents. We're seeing modern bulk space quoting between $10.50 and $11.50 NNN.
And for our listeners, NNN, or triple net lease, means the tenant pays for taxes, insurance, and maintenance on top of that rent.
Correct. And those rates, they rival major metros like Chicago or northern New Jersey.
But with way lower property taxes and zero port congestion, that's a powerful value proposition.
It's huge. And finally, let's look East Met Comfort, Greenfield. This is where you find the lowest remaining large tract land prices, maybe $4 to $6 a foot.
And it has an anchor of its own coming.
A big one. Amazon's 1.2 million square foot robotics center is opening in early 2026. That is going to be a magnet for supporting logistics and parcel operations for years to come.
So it sounds like the common thread here, beyond location, is power. Guaranteed delivery of power.
It's become the new #1 constraint. I mean, if you're a big national tenant looking for space in 2025, the very first question your broker asks isn't, what's the rent?
It's how many megawatts and when can you deliver?
Exactly, because modern warehouses are power hogs. We're talking 10, 20, even 30 megawatts per building for automation, robotics, and all the future EV charging infrastructure they need to build in.
Without that power, the building is basically obsolete on day one.
It's a stranded asset, and Duke Energy's own maps from late 2025 show that only 3 Indiana counties can guarantee that 10-plus MW delivery in under 24 months. So that scarcity is reshaping everything.
Power capacity is the new location.
It really is.
Okay, that's a critical point.
Yeah.
Let's pivot to the math. The fundamentals are strong, but what's the financial safety net? What protects a buyer if rates move or tariffs shift?
The protection is baked in. It comes from buying at a significant discount to what it would cost to build that same building today, to replacement costs.
That's your margin of safety.
It's the single biggest margin of safety you can have. It minimizes your risk, no matter what the short-term noise is.
So let's get specific. What is that margin right now in Indianapolis?
Okay, so to build a new Class A bulk warehouse in the area today, your all-in replacement cost is somewhere between $190 and $220 per square foot.
And what are they actually selling for?
Current transactions for similar recently built properties are happening in the $120 to $155 per square foot range.
Hold on, let me repeat that. You're saying I can buy a high-quality, modern building for $140 a foot today when I know that no one can build a new one for less than, say, $200.
Exactly. You are buying brand new quality at a 30 or 40% discount to any future competition. That cost gap just absorbs an enormous amount of risk.
And you combine that with the predictable rent growth coming in late 2026 when that empty pipeline really starts to bite.
That's the formula. The buyer leverage is at its peak right now, and the payoff is baked into the near future.
Our sources also mentioned the process of finding these deals. Something about an advanced acquisition system to capture that discount before anyone else.
Right, because during a rebalance like this, the best deals are almost always off-market. If you wait for a property to hit a public listing, you're already too late.
You're competing with institutional money.
You're competing with everyone. So an advanced strategy means, daily pulls of assessor records, identifying owners who might be under stress.
Like they have debt maturing or rising vacancy.
Precisely. Then you use data enrichment tools to get contact info, and here's the key step. Using AI for motivation modeling.
So using data to score how likely an owner is to sell based on their financial situation.
It lets you filter out all the noise and focus your resources only on the owners who are most likely to transact in the next 12 months, letting you get in there and negotiate before it's a public bidding war.
It's the definition of hunting for the deal, not waiting for it. Okay, let's synthesize this. The national market is normalizing, which has created a temporary window of pricing leverage for buyers.
And that leverage is best used in a handful of markets that have guaranteed future demand. Indianapolis, with the Eli Lilly expansion and the Duke Energy power advantage, is uniquely positioned to capitalize on this.
So industrial real estate is still a top asset class, but only in markets that check all three boxes. Available power, a huge corporate anchor, and a central location.
Which leaves us with a final provocative thought for you. Historically, investors have obsessed over metrics like rent-to-vacancy ratios, absorption, cap rates, all the classics.
But based on everything we've looked at today, the new critical measure of value, the real competitive advantage in modern industrial real estate, it's rapidly becoming megawatts per square foot.
Just consider how that one single factor access to significant, reliable power will separate the winners from the losers in the next cycle. It will create stranded assets in some markets and huge premiums in power-rich markets like central Indiana. Thanks for joining us on the Deep Dive.